Hi everyone, today we are going to make a video on slippage. Now, if you are an option trader, slippage is of great importance to you. You must always be lookout on how to reduce the slippage. Now, slippage can be caused by a lot of factors, one of them being spread. A spread is the difference between the best bid and the best ask on any given contract. Now, some of these contracts by nature are liquid and the difference is quite small, so it does not matter. But there are contracts in our options trading, especially when you go to like Bitcoin, where the difference between the bid and the ask is huge, right? So a normal paper trader, what it does is most of the tools available in the market will assume that you are going to enter a position and exit at the latest traded price, which is this one, right? But in reality, when you do it in the market, you are actually entering a position. If you are doing a buy, you know, you are actually doing it at the best ask and you are selling at the best bid, which is different. Like for this example, right? Now, in this particular example, right, let's look at it. So you have a latest traded price at 562 rupees, the best bid is 559 and the best ask is 569. So there's a difference, a spread of almost 10 rupees here, you know and the LTP is probably the midpoint of the bid and the ask. So your paper trader should be able to account for this, which is very important in your trading. Now, how do we do that, right? So by default, when you go to our paper trader under options, which is in the settings, the paper position entry and exit is based on LTP, which is the latest traded price, meaning you will enter at the latest traded price and also exit at the then available latest traded price. But like I said, this does not account for spread related slippage. So we have introduced a new option called bid ask. Now, what it means is when I were to enter, for example, in this classic case, right, if I were to enter, I would enter at the best ask if I were to buy this contract, which is 17,300 on Nifty. And if I were to sell it immediately, it would be a market order at 559. So invariably, if I were to buy and sell immediately, I would incur a loss of 10 rupees. Now, if I do the same using LTP, it would just show a gross P&L of 0 because you are entering at LTP and exiting at LTP, which hasn't changed since the market is closed. And even during market hours, like it would just give a difference between the LTP at point you start enter and the LTP at the point you exit. So there might be little differences ranging from a couple of rupees to thousands of rupees depending on how liquid the contract is. And so we suggest that this is a good way of paper trading if you have it on the bid ask mode. So here I'm buying one quantity of this contract, 17,300. So when I buy, like I said, I should enter at 569, like it shows the entry at 569, guys, here, right? And when I exit the position, now I'm trying to exit it immediately, right? It should exit at 559, which is the best bid. So that's your 559, right? So in reality, I'm incurring a loss of almost 10 rupees, okay? And one lot is 50 contracts, so it's like 10 times 50, almost 500 uh, rupees of loss that I'm incurring if I were to enter and exit this position immediately. But if I were to do this on LTP, this would show as 0, which is not in our opinion a true view of the real world. So this is how one of the new features that we brought can help you sharpen your edge while paper trading on OptionDesk. Thank you so much for viewing this.